The capital asset pricing model. Capital asset pricing model, or Capm, is one of the major developments in modern financial theory, widely used in investment analysis. In this video, we will use the basic principle of Capm to explain how risk should be considered in a scenario where stocks and other assets are held in portfolios. So the capital asset pricing model, or CAPM, is a model based on the proposition that any stock's required rate of return is equal to the risk-free rate of return plus a risk premium that reflects only the risk remaining after diversification. This model provides a general framework for analyzing risk-return relationships for all types of assets. In evaluating these relationships, CAPM does not use total risk, which is measured by standard deviation as a risk measure, but only one part of total risk called systematic risk. Now, total risk may be separated into two major components. First is the diversifiable risk, also called unsystematic risk or company risk, and undiversifiable risk, also called systematic risk or market risk. Okay, so we will first discuss the diversifiable risk. Diversifiable risk or unsystematic risk or company risk is that part of a securities risk caused by factors unique to a particular firm. Unsystematic risk can be diversified away because it represents essentially random events. So negative events affecting one firm can be offset by positive events affecting another firm. So the sources of diversifiable risk or unsystematic risk include lawsuits, strikes, company management, operating and financial leverage, marketing strategies and research and development programs, and other events that are unique to the particular firm. So because these events are random, so take note, because these events are random, their effects on a portfolio can be eliminated by diversification. Okay. Now, let's move on to undiversifiable risk. Undiversifiable risk or systematic risk or market risk is that part of a securities risk caused by factors affecting the market as a whole. Systematic risk cannot be eliminated by diversification because it affects all firms simultaneously. Okay, take note, undiversifiable risk cannot be eliminated by diversification because it affects all firms simultaneously. Some companies are more sensitive than others to factors that affect systematic risk. Systematic risk is therefore the only relevant risk and is affected by such factors such as, okay, as shown here, wars, inflation, right? Interest rates, business cycles, fiscal and monetary policies, and therefore cannot be eliminated by diversification, right? So we are of no control to the wars, to inflation, the interest rates, the business cycles, and the fiscal and monetary policies. Okay. So this diagram shows the effect of diversification on unsystematic and systematic risk. Okay, this diagram. Here, the number of securities in portfolio. Okay, this one, the portfolio risk. Okay, on top, this portion, the unsystematic or diversified risk, and here the systematic or the market risk. Okay, so as shown here, it can be observed that as the number of stocks increases, okay, from 5 to 10, example, the diversifying effect of each additional stock on systematic risk diminishes. Okay, example from 0 to 5, the number of stocks, so the risk is very high. Okay, as the number of stocks increases, okay, like 20, the risk diminishes up to here only. So this is the graph as shown in this figure. So if stocks included in the portfolio are carefully selected rather than adding them randomly, the graph would change. In particular, if we chose stocks with correlations with one another and with low standalone risk, the portfolio's risk would decline faster than if random stocks were added. So the reverse would hold if we added stocks with high correlations and high standard deviation of expected returns, right? Since most investors are rational in the sense that they dislike risk, yes, who would like risk? Nobody likes risk. Other things held constant. Now, why would an investor hold one or only a few stocks? Why not hold a market portfolio consisting of all stocks? Okay, there are several answers to the second question. Okay, why not hold a market portfolio consisting of all stocks? First, high administrative cost and commission would more than offset the income for individual investors. Second, index fund can be used by investors for diversification, and many individuals can and do get broad diversification through these funds. Third, some people believe that they can pick stocks that will beat the market, so they buy them rather than the broad market. And fourth, some people can, through superior analysis, beat the market. So they find and buy undervalued stocks and sell overvalued ones. Thus, in the process, most stocks become properly valued with their expected returns consistent with their risk. Okay, so that's it, diversification. So I think you have heard of the saying that do not put all your eggs in one basket. So that is diversification. So if you have a stream of portfolios, okay, so that you diversify it. Okay, if you have example 1 million, do not put your 1 million in one bank only. All right, so you diversify it. Okay, so that's all for CapM. Thank you for listening.